Tesla is having a terrible year on the stock market. Its self-driving cars are having their best year yet. Over the past year, the software has roughly tripled how far those cars drive between serious mistakes. And the newest version is already carrying paying passengers with no one behind the wheel. Those driverless cars have now covered more than 380,000 miles on public roads, by Tesla's own count, with zero notable incidents. That is like driving all the way around the world about 15 times. Here's what the market stared at instead. In July, Tesla lost more than a quarter of its value. The stock fell below $300, near a one-year low. The headlines were about shrinking car profits and cash going out the door. So two very different things are happening at once. The car business is getting weaker. The self-driving software is getting better, fast. Much of the market fixed on the first and arguably misread the second. One of these two stories is a distraction. The other is the real bet. This video is about why the second may matter far more. Start with the bad news, because it is real. Car profit margins dropped to about 16%, down from above 19% a year earlier. Operating profit fell by more than half. Earnings came in well below what analysts expected. And free cash flow, the money left after spending, went negative by about $1 billion. Every one of those facts is true, and every one is about the car business. But the car business was never the reason this stock was worth a fortune. Now the part the headlines skipped. Tesla is sitting on more than $40 billion in cash, a pile that grew 18% in a year. And simply running the company still produced about $4.7 billion in the quarter, up 85%. Free cash flow went negative for one reason. Tesla spent nearly $6 billion on new factories and equipment, up 142% in a year. Almost all of it went into artificial intelligence and self-driving, into chips, data centers, and the lines for a purpose-built robotaxi. Picture a shop that makes good money every day. The owner takes all of it, borrows more, and pours it into building a new business next door. From the street, the shop looks like it is failing. Really, the owner is making a much bigger bet on purpose. And the runway is long. At last quarter's rate, that cash alone could last about 40 more quarters. That is roughly 10 years before Tesla touches the $30 billion it plans to borrow. The car side is not even weak everywhere. Deliveries hit a record last quarter, up about a quarter from a year earlier, and sales over 12 months passed $100 billion for the first time. So the real question is simple. Can Tesla stay funded long enough for robotaxi to grow up? On these numbers, it has years to try. Now the number this whole company is really priced on. A group of Tesla owners tracks it by hand. Every time the software makes a mistake bad enough that they grab the wheel, they log it, then pool the results. It is the closest thing to a public error rate for the system Tesla calls full self-driving. It is imperfect, but it is real, and it updates all the time. And it says more about Tesla's future than any line on the earnings sheet. The measure is simple. It is how many miles the car drives between those serious grabs. Think of it as how far the car goes before it does something that scares you. Version 13 managed just over 400 miles. Version 14 late last year pushed past 1,500, and at times near 2,000. That is roughly 3 to 4 times better in one release. In plain terms, the average driver covers about 250 miles a week. So version 13 meant grabbing the wheel about every week and a half. Version 14 stretched that to more than a month. Same driver, same roads, one software update apart. And this is not about bragging rights. Below a certain number, a robotaxi still needs a person ready to grab the wheel. Above it, the car can finally run alone. That threshold is the whole game. Now version 15 is here. Tesla says its robotaxis are already running it, and its head of self-driving called it 7 major steps better than 14. It reached the paying fleet only weeks ago. Here is a bolder read, and it is a projection, not a fact. Those 380,000 clean miles were driven by only about 20 robotaxis, by outside estimates. That is close to 20,000 miles per car with no notable incident. Even at half that, you land near 10,000 miles between serious mistakes. That would be 5 times better than version 14, and that fleet is the one now on version 15. If that reading is even close, these cars would go months of ordinary driving between serious mistakes. Treat it with care. This tracker is crowdsourced, not audited, and the numbers swing. So any figure for version 15 is still a guess. But the direction is the point. Every dollar in Tesla today is a bet on how far its cars drive between serious mistakes. Start with the prize, because it is enormous. Moving people and goods by road is one of the biggest markets on Earth, worth trillions of dollars every year. Take the paid driver out of a taxi ride, and you cut its single largest cost. Win this, and you own something rare. A fleet of cars that can earn around the clock, with no driver to pay. That is what everyone is chasing. By one measure, Waymo leads. The self-driving arm of Google's parent is real, and it is safe. It has driven more than 200 million miles with no one at the wheel. It gives about 500,000 paid rides a week across a growing list of cities. On cars carrying riders today, Waymo is ahead. But look at how it grows. Waymo maps each city in detail, tunes for local roads, then opens slowly with safety drivers before trusting the car alone. That is safe, but slow and costly, one city at a time. It is now even shipping in cheaper cars from China to hold costs down. Tesla is betting on a different shape. Its bet is one general system, trained on billions of miles of camera video from its own cars. That system could move into a new city with almost none of that local setup. Waymo builds each robotaxi by hand. Tesla already has millions of camera cars on the road, many of which could get the software one day. Waymo would need years and billions to build a fleet that big. Tesla already has the cars, so judge the race by the technology, not the head count. On that measure, a strong case says Tesla is the real leader. What is behind is the number of cars on the road, not the software. The next name people raise is China's Xpeng. Its system is real and improving. But by public side-by-side comparisons, it looks about where Tesla was 2 versions back, near version 13. That puts it roughly 2 generations behind. This is what the bears keep missing. They score Tesla on last year's car profits, not on where the tech is going. And the rest of the field is quietly drifting Tesla's way toward cameras and data. Even rivals built on costly laser sensors are leaning harder on vision, the very approach critics said would never work. Cameras cost a fraction of laser sensors. That keeps the price of each car low enough to build millions. Then there is the fear that regulators block it all. So far, the reverse is true. Amazon's Zoox just won federal clearance to run cars with no steering wheel and no pedals at up to 75 miles an hour. Every company that has shown its cars are safe has been cleared to grow. So the deciding factor is not the rule. It is whose technology is actually ready. There is even a reason cities may want this. A robotaxi network is a kind of public infrastructure, like roads or trains. A place that gets it early could see less traffic, cheaper rides, and a lift to its local economy. That is a reason to welcome these cars, not block them. And the momentum is quiet but real. Tesla expects robotaxi miles to grow more than 10% every week. At that pace, a number doubles about every 7 weeks. Underneath sits a loop. More cars send back more data trains better software earns more miles. If that loop turns, the lead builds on itself, out of sight. None of this is proof. but the signal tends to show up in the data long before it reaches the share price. By the time a robotaxi business is obvious in the earnings, that early signal will be years old. The people reading the data see the turn first. So ignore the daily noise. A short list actually matters. First, the version 15 error rate, once enough owners reported. Either it clearly beats 14 or it does not. Second, driverless miles each quarter. The count is near 380,000. Watch it reach for 1 million, then 10 million. The speed of the climb matters more than the total. Third, watch the number of robotaxis actually on the road, not just the miles they drive. Tesla still hides it. A real network needs thousands. A trial needs a handful. The day it shares that count, you will learn a lot. Fourth, cash from running the business, not free cash flow. Free cash flow drops on purpose when Tesla spends big. The operating figure shows whether the core still funds the bet. Fifth, the first clearance anywhere to run with nobody watching the car. The first one changes everything. Here is the one assumption everything above depends on: that each new version keeps improving as fast as the last one did. Pull that assumption out, and the whole case falls. So here is a fair thing to argue about below. Pick your own number. Say how many miles version 15 will go between serious mistakes, and explain why you landed there. The cars are earning less, and that part is real. But every dollar in Tesla today is a bet on how far its cars drive between serious mistakes. If you want the noise stripped down to what really drives the stock, subscribe, and the next one will do the same. One last thing. The content in this video is for reference only and does not constitute investment advice. All investments carry risk. Please make your own judgment based on your personal circumstances.